Morning, everybody.
Hello.
Thanks very much for coming out and being here on time. My guest today is Atit Ahluwalia. I've known him for 15 years, and as you might come to find out, he's very articulate and probably one of the smartest people that I know on a whole bunch of stuff. Atit, let's start with how you got into venture capital. When we met, you were a proprietary trader at Goldman Sachs, which is kind of like the job when you're a prop trader. You want to be at Goldman because they have unlimited money. They see a lot of order flow. What would ever prompt you to leave working Goldman as a prop trader?
Well, I think I just got really exceedingly lucky. I started there out of college, and you're getting coffees, you're writing trade ideas or whatever, and then we had a once in 100-year global financial crisis, so they couldn't babysit me, which practically speaking meant that I became head of credit options, credit arbitrage, and cross-asset prop. And so that getting in there was a freak of nature occurrence. Dodd-Frank came in. We were no longer getting paid what we got paid, and risk limits were reduced by 90%. So went to a hedge fund. That hedge fund scaled. We did really well. And then when the patriarch decided to become a family office, we were all essentially fired. And so that was the catalyst for me starting a business in the cryptocurrency space in 2015, selling it 3 years later, and that's when I decided, I'd rather be a part of the medium-term kind of alpha generation story as opposed to trading day to day.
So when you were trading, what impact did algos and high-frequency trading have on you when you were kind of not day trading, but you weren't really taking positions home overnight? You were marked to the market every second, it seems.
Yeah.
And there was no longer this unfair advantage on information anymore. How did that impact your trading?
Well, the ARB went away. I think in '08 you could run simple studies, and a lot of mutual funds deployed based on when they received capital in the month. And so if you knew that the last trading day of the month was down by a certain percentage, you can ascertain what the 80% probability of it rallying the next session by how much. Really basic studies all the way through to more complex were available to you. And so, I run that, and then by the time 2011-12 started rolling around, high frequency was obviously a big presence in the market. 100% of that ARB went away.
Oh.
So it was one of those situations where you no longer had ARB at your back to kind of cushion your prop bets, where you could aggress the market, and you had to be right quickly early in the year too to make sure you had a job.
Now, you were early to see the benefit of, or the interest anyway, I'll say, of crypto, and you and some friends started a humble little crypto business. Tell us about how'd you find your way into crypto, and then how did that lead to venture capital?
I had a college roommate who's an order of magnitude smarter than me, and he's like, "You like gold, and gold is stupid, so why don't you buy digital gold?" That's literally the entire conversation. So I started doing that in 2015 when he introduced it to me, and then after the hedge fund had wound down, two buddies, we started a crypto exchange because if you wanted to buy 100K worth of Bitcoin, it could take you 8 hours on a Friday at Coinbase back then. So we pooled liquidity globally, and you could do it in a minute. And so we became top 12 in global flow in the next couple of years, and got really lucky. Bitcoin, rallied 2 orders of magnitude, and we sold that.
What was Bitcoin at that time?
It went from 400 to just under 20K. Yeah. So it's funny, kind of in between Goldman and the hedge fund job, that's actually where I met Michael, and he was giving me advice on how to pyramid positions, and that happens to be the greatest advice I've ever gotten in terms of Bitcoin and adding your protective stops.
So fast forward, we're in Island Green now, and you had a good exit. You sold the crypto entity, cashed out, and now you're with Island Green. So your company, what type of investments? Because VC, you can be an angel investor, you can be late stage. Where are you guys in the food chain?
We're growth and late. So half of what we do is Series A to Series C. The other half is C+. Anything where we can integrate into management, help them with debt finance, help them with connectivity to the DOW and classified branches of government, et cetera. And then 97% of the time we stay silent, so no board seats or anything like that. But I've been really fortunate to be direct to cap table in names like SpaceX, Airbnb, Palantir, Coinbase, Roblox, Stripe, all while some of are still private, but all when those other companies were private as well.
Wow. I've heard of a couple of those. That's good stuff. So are you focused nowadays mostly on technology, or where do you draw the line?
Yeah, deep tech, hard tech, anything that we think can exhibit oligopolistic unit economics or better. And that usually means that there's a degree of complexity which requires a higher underwrite, which means we have less competition when it comes to investing in it.
I like that. What when you start, do you care about the cap table when you look at the investments and who else is on that cap table, or is that more from the seller's standpoint?
Yeah, I look at it insofar as I'll have connections to most of the people there, and I'll be able to do cross-reference the data we get from the company, the data we do for government and supply chain, like channel checks, et cetera.
Yeah.
But it does not matter if a really great investor's already on the cap table, because, I mean, if you're seeing a deal at Series E, and Sequoia led the seed, it's because they want you to see it, because there's no more juice left in that investment. So from that perspective, it's less relevant. It's more relevant if you want to call someone at Sequoia and diligence it. But as far as like being a core ingredient of why you would invest, you want to know the top 30 firms in venture, know what they're working on early rather than later, because the top 30 firms run 80% of the capital. So it's still very much understanding the structure of the market in terms of supply and demand, where the capital's coming from, how durable it is.
So it's safe to say that by the time you get past Series A, Series B, that the risk is a little bit less, because the company has legs, they have a business, they might have revenue, they certainly might have a high number of average monthly users.
Yeah.
In angel investing, you're really kind of evaluating the company, but also the person who's going to run it. Does that person have grit, or are they still 35 years old living at home with their parents?
Yeah,
like
I can't handle the hit rate at angel investing. Like we get evaluated. We're backed by one of the largest 3 banks in the U.S. and then a bunch of hedge fund managers that, you know, guys I worked for at Goldman are the bedrock of our capital, and would chop my head off if I lost their money. And so, you know, when it comes to that part of the market, angel investing, the hit rate is so low that I don't think I could emotionally handle it.
Yeah, I mean, there's an expected value, I guess, of a trade, which I'm kind of used to being right. As I work with Victor Sperandio in managed futures, and if we're right 30-40% of the time, that's kind of considered good. The idea is when you lose, you want to lose paper cuts, and then let your have gains that are asymmetric with what you're losing when you lose.
Actually, there's one other critical point. I think venture capital doesn't work anymore. Venture capital works when rates are 0 or decreasing. It works when you can make 50 bets, hope one's Airbnb, and pays for 49 cents. That's it. That's how venture capital works. That's why it's worked for the last 40 years. In a rising and volatile interest rate environment, whether you look at Oatsbunds, Gilts, JGBs, Treasuries, whatever, you need to be concentrated in names that have a real shot at being an oligopoly or monopoly, that kind of own their subsector, because they're actually creating the TAM in those investments. The tailwind's very strong, and most of these companies, as you guys all know, are staying private for longer. I think Amazon debuted at a $200 million market cap. SpaceX is about to go out at, you know, an ungodly market cap, well-deserved, but still like incredibly high for a private company. So yeah, I think that venture is very interest rate sensitive, and in the next 5 years, you'll see more GPs kind of disappear. Over half the GPs in venture have actually disappeared in the last 5 years, which is actually good for our business because we do primaries and secondaries. We buy off of people that are in stress occasionally, with management's knowledge and blessing and all that. But I do think that's a really critical thing to understand, because venture is starting to get a lot of heat from traditional institutions that want to put more private capital to work for retail.
So let me just take a step back here.
Yeah.
When you're building your team, like what kind of people are you looking for? CFAs and MBAs, or do you need people who just know a lot about a lot of things? Like I can sit here actually feel it in my body that I'm not going to even have a job interview with you because I'm so intimidated. So what kind of person would you hire? Like, what are you looking for?
Everyone on the team is smarter than me in at least a couple dimensions. So it's funny, when I started the firm a few years ago, I said to my wife, like, mission one is find people smarter than me. She's like, oh, great, that'll be easy. She didn't even think that's what she was saying. And I was like, yeah, I guess that is a low bar. But no, if you look at some of my colleagues, some of them were director of operations at SpaceX. They co-incubated Neuralink and OpenAI, clearly brilliant. Some of them are AI native researchers. One of them used to run secondaries for the most important secondaries player in North America and private markets. One's a forensic accountant that gets called in by the government to do analysis on anything they deem a fraud. Same thing with Fortune 1000 companies, they call him up. So it's not easy to find incredible people, but they're all brilliant and aggressive and then aligned with the wins of the firm.
Is it important that they have connections? Because when I grew up, I'm a little older than you, everything was like, you got to build your Rolodex. Rolodex was this spinny wheel kind of a thing, and you'd have stapled business cards in there. Yeah. Now everything you can do all that on your iPhone. But it was all about relationships, because this is pre-cell phone, pre-internet, pre-LinkedIn, and pre any kind of networking, Toastmasters or what have you. So you really needed to network and know people. Is that important? Human capital?
100%. I think half the team, like the younger members of the team, you can't expect them to have a Rolodex and 500 people they can call for information. But as they mature and as we put them in front of people, they certainly get that. Yeah. I think that there's a high degree of information asymmetry in private markets. In fact, it runs on imperfect information. So you do have to have that Rolodex. You do have to know who to call when you want financial numbers or to triangulate. Who do you call in the government to verify a program of record with the Navy? Who do you call in the supply chain to make sure that they actually have antimony reserves to actually create that hard tech product? So I think it's not just who you know on the investor side, but it's also on the operator side, the supply chain side, the government side, the competitive analysis side. And that just takes time to build. But you absolutely have to have it. Yeah.
Yeah. When you're looking to make an investment, is it important for you to know who else is taking on risk at that stage of investment? Like you said, A through C and all this and that. Like, does that sway your decision-making process? Or do you say, like, I know what I'm doing, I also have a gut feel for this thing, I know the industry, and, what's the calculus there?
Yeah, I think you always want to know structurally who's on the cap table. For the simple reason that since 2018, mega funds have been raised in venture. Like before then, I think the highest dollar value fund was $2 billion. Then SoftBank came out with a $100 billion fund. So everyone had to raise these mega funds, and they need to deploy, $300 to $500 million at a clip to make it worth a needle-moving investment if it works, right? So I need to know who's on the cap table. In the event that they run into trouble, I have to analyze their portfolio and see how much supply there would be in that event. But that's part of the equation. We have to be obsessed with the company at par. If we're obsessed with buying them in the primary round or even overpaying, we're integrated with management, we understand a forensic picture of them inside and out, that is like the core of the actual investment process. And then we get lucky. Like there's been a handful of 20% drawdowns in the last decade in the NASDAQ, certainly occurring at 3-4 times the speed of prior decades. And so within that, we can find the guys that have raised mega funds that may want to sell some of these positions if they were to get into trouble. So the structural part of it's very important, but it's not going to be the deciding factor for whether we invest.
Do they ever come to you with special terms and say, you have to put in a certain amount, or we need to see your capital? Because the rules in VC are a little different than in commodity space, where we can't really commingle our funds with clients, unless we were in a pool.
Yeah.
And nowadays, everybody, you just saw Michael Burry from, what was that movie? He was
Big Short.
The Big Short. There you go. He's deregistering his hedge fund to probably convert to a family office. I don't think he's going out of business by any stretch of the imagination. Yeah. But you saw Steve Cohen, right? We have .72 in the room with James Malik. He's going to be moderating the fixed income panel. Family office, right? Yeah. So how does the regulatory environment affect you with raising money, running money, and all of that? Is it?
Well, 100% of our capital is on reverse inquiry. So people come to us to ask to invest, and that's usually referrals from our current clients. 70% of it's institutional, it's hedge funds and banks. The hedge fund guys, I'm a former hedge fund guy, they're quite aggressive. To show alignment, I'm 3% personally of everything we do, and I'm subordinate. So there's a really thin 3% first loss piece that is me. But that buys me the credibility to then concentrate the portfolio, be very aggressive with certain investments, primary or secondary, invest in things when maybe they aren't as well known. They're not logos of today, they're emerging technologies. But yeah, I think that, you know, when it comes to regulation specifically, the easiest thing to do is to adhere to what you would have to do if you were SEC registered. So we're SEC registering in January. So all those processes are already in place. It's just, why mess around?
Yeah, understood. So you mentioned SpaceX before, and I kind of know the backstory, but I think it'd be very interesting for the folks here to hear this. It's run by Elon Musk for the most part. This is kind of a case study. I want to get into the case studies later, so don't give the case study answer. But when you look at SpaceX, how do they make what's their revenue? How do they make their money?
Yeah, so I think Elon tweeted that they're probably going to do 15 billion of revenue this year. It's about half launch and half Starlink. They are 82% of the global launch market. That includes China, that includes Russia, that includes all of our allies. They dominate that market. I think something crazy like 90% plus of the mass historically ever ejected into space comes from a SpaceX rocket. The second way they make money is through Starlink and Starshield, which is the internet telecoms, space-based constellation that they run. And if you look at Morgan Stanley's reports, they said that for every million Starlink subscribers they get $3 billion of top-line revenue, $2 billion of which is recurring. So it's a pretty formidable business that's in its early innings. They've laid the track for that. And I think that I think people will consistently be shocked at how they CAGR. They're 98% of SATCOM. They're 82% of launch. Like, they are the dominant player. Like, we will never invest in another launch business. Why? I mean, it's like, why would you? Yeah. It's a winner-take-all world, and in a concentrated portfolio, I mean, it pays to be in the best names at the right price. And we've been lucky that they've allowed us to add over the last decade at nearly every single round.
So when they allow you to, let's go back now. It's Elon Musk. He's got to be worth about $80 trillion right now for all intents and purposes. Yeah. He's not worth. Why in the name of Christ the King does he need your money?
He doesn't. Capital's fungible. You don't need a $20 million check from us, certainly. I think it's more about the respect you show in terms of process. One of my colleagues used to work there for a decade, and so when they ask, when different people ask at whatever level of the company, hey, I need you to do this or that, she gets it done. When I get asked for very rare special projects, I make sure I get it done, and we just don't try to have an arrogance about our value add in the ecosystem. When I had investors in my crypto business, they would give me illegal advice because they didn't understand the regulatory landscape of finance and crypto. So investors can actually get in the way more than help. And so when they ask us to help, we help. If we have an idea, we send it to them, and we do not waste their time. When we say we have 20 million or 200 million to put in, we do KYC, AML, basic stuff that everyone in this room has done their whole career. And we make sure we deliver on time or early. So it's just being respectful of the process, because they can take money from literally anybody in the US or abroad.
So then, for context, because they could self-finance, who are the existing shareholders that are selling stock to you when you're making these rounds? Who are the shareholders that are selling? So
I can't get into who's actually selling, but they do an employee tender where you can sell a few % of your shares, usually 2 times a year, to provide employees liquidity. The common trades flat to the pref. And so that's typically where the bulk of the supply comes. They've done a lot of buybacks in the past as well. I mean, pretty formidable cash generator. So they kind of can control their destiny in that sense.
So when you, maybe this is, I don't know if this is out of bounds, but I'm going to ask you anyway. If you can't answer, you can't answer. For the way things are going with them, it's entirely possible that they'll never IPO.
Yeah, I think that's certainly possible. Elon came out, I think it was at the Tesla Investor Day, and said, maybe we need to IPO. My game theoretical approach to that, which has no bearing in reality because no one at the company and I have ever discussed it, was, if the Democrats win the midterms, then, if you're certain companies, you probably want to IPO in the 3rd year of Trump's presidency. Elon coincidentally, said that, hey, maybe it's worth IPOing despite the headache. I think it was like 2 days after the sweep of Democrat elections across the nation. So I think that there'll be a lot of folks, there's a lot of supply in the pipeline that needs to IPO, that would like the capital. They certainly don't need the capital. Right. It's just a question of desire, and that'll be determined by Elon and Gwen and the rest of their team.
There's also another factor at play too, like right now, for all its success, it's still a private company.
Yeah.
When you go IPO, you put a public market multiple on all of that stock. So wouldn't that be a tide that raises everybody's boats?
Yeah, I mean, it would be, but I also think SpaceX is underpriced relative to where it would trade in the public market. I pay 47 times earnings for Costco. It's a oligopoly with 2% gross margins. It just happens to be, trading at that level because they can execute better than anybody else. What would you pay for a business with north of 50% gross margins that owns 98% of Satcom and 82% of global launch? You'd pay a lot. And the best example I can give is the Destiny XYZ ETF, DXYZ. I think like 60% of their assets are SpaceX. It trades at 5 times NAV. The rest of the ETF is a long tail of assets. I think there's 3 or 4 great ones and a lot of stuff that needs a lot of work based on the valuation they bought it at. So I would love it if they went public, but I'm just kind of grateful to be a part of that journey. They don't need anything from me. They're really just been very good to us.
I understand. I've been in those situations too, where I'm very happy to just be sitting at the table with my mouth closed and just doing, letting my ears do the work. Let's talk about liquidity events. Like suppose SpaceX does go public, or somehow they get merged with another company, and all of your shares become liquidated. You have a very unique way of handling liquidity events that I think is different from other venture capitalists, considering that most have a 2 and 20 structure. Yeah. What do you do when you come into liquidity for your clients?
We just send it back to them. So we will ask the company for permission. Hey, can we send shares in kind? Because certain family offices have tax events they want to plan, or do we have to do all cash? So the minute that we're unlocked and available to do that, we do that literally that day. And then we step down management fees for the rest of whatever they've deployed with us. My goal is to get people their capital back in a shorter duration. Like in venture capital, it's usually a 10 to 15 year duration, closer to that 15. For us, I think we try to return 100% of capital within 5 years. And then we try to deliver 3 to 5x net. That would consistently put us in a top 1% position. But equally, I'm a first loss piece, so I definitely need to deliver cash as quickly as possible. It's just one of those weird situations where, as an investor in other funds, it's annoying when somebody's charging me fees on something I could buy in my Schwab or Fidelity or Interactive Brokers account. That doesn't compute to me. Like, why would I pay 2 and 20 for that? So for us, like, our philosophy has always been get the money back to people as quickly as possible on any liquidity event. And one nuance there is we re-underwrite these companies at every successive round or major secondary transaction. So it might be that we sell it pre-IPO in the secondary market to a family office in Toledo, Ohio, or something like that. And in that case, we return the capital as well. So it has to stand on its own merit. And whatever it is that delivers a multiple on capital back to investors quickly is imperative.
It must also create, maybe this is obvious, but an enormous amount of goodwill with people, because that business is notorious for lockups.
Yeah, I mean, we don't ever want to get caught in that trap. It's not an AUM game. We want to be on the efficient frontier of size versus returns. So we always undersize our fund by about 70 to 80% relative to that. If there's more access to some of these names, then we'll just spill it over into reduced fee co-invest. It's all direct to cap table. It's all with full data and management knowledge and blessing. I think if you're a family office or a bank or a hedge fund or any type of institution, you want to control your destiny in that way. And you want to get reduced fees, candidly, on the co-invest. And so if we can shrink the size of the fund, we can deliver our target return and still give people the access that they require and the quantum they require.
So we're all reading the same papers. It seems as if, Bitcoin and crypto are in the conversation. Certainly AI, right? Yeah. And then powering all the AI with, batteries and energy. What is your take from a VC standpoint on what you see with AI? Like, valuations and volatility seem to be gigantic right now. When you look at this, do you shake your head and say, people are going to lose a lot of money.
Well, they're definitely going to lose a lot of money, but it depends on where you invest in the AI stack. Are you doing it in the silicon, which is increasing in valuation, but you can't really test it unless it's deployed in scale? Then you can see if the lab results match real-world results. Are you doing it in the form of the LLMs, which are generating the bulk of the revenue, or coding assistants at the application layer? Are you doing it, we like looking at all of the above, but also at bottlenecks in electricity generation and supply. And so are you investing in step-down transformers to make sure that the grid electricity is actually readily available and usable by your hyperscaler like data center? There's 100 different ways to do it. I just think that when you buy something at 1,000 times next year's theoretical forward earnings, it presents a lot of problems. And so, I mean, that's actually good for us. We're concentrated. We're investors in XAI. We've been fortunate to be a part of that story. And then for AI specifically, the only, one of our use cases is in aerospace and defense. And what we want is for you to deliver the best technology in the world, which AI often represents, but then you also have to reduce the cost to the end user by an order of magnitude, because that's the only way that they're going to look at you, and that's the only way that the procurement manager will be fired for not buying your product. So the tailwind is that great. And when you look at defense, whether it's autonomous attritable mass, things that keep troops out of harm's way, things that allow us to actually have an economic advantage as well, that's mission critical. And I think if you look at the U.S.'s debt situation at 125% debt to GDP with 7% deficits in peacetime, we're in fiscal dominance. We could go into that if you want, but you need to find things that lower the cost to the Pentagon, and AI does a marvelous job of doing just that. So if you can net save money, that could be a good thing. Just a quick example on that is, an MQ-9 Reaper's $33 million, right? It's an ISR drone with offensive capability. A Chinese Shi-2 missile is $2 million. So in every exchange, if they shoot down a Reaper, even with 3 missiles, we're net losing $27 million in that transaction. They're a surplus economy. We're not. But if Shield AI makes a drone for $600K, now we're net gaining $1.4 million on that transaction. So you do have to think about the sustainability of our military and industrial policy, not just on a supply chain basis, not just on an industrial capacity basis, but also on a cost basis, given where we are as a nation at this point in time. There's a lot to think through, the implications of AI, and that's just one use case.
That's a long conversation we could have about that.
Right.
But the thing that comes into my mind are the rare earth metals and everything that you need. Yeah. So as a company for, Island Green, do you, without saying any specifics because you might be under NDAs, but are you looking, what other industries are making you excited right now that are new for even your eyes?
Yeah, we're opportunistic, but I was lucky in the public markets. You get to trade a lot of sectors if you run an index pod, which I did. But we like to look at aerospace and defense, manufacturing, robotics, industrialization, which is a fancy way of saying cramming electrons onto the grid. We look at some fintech, some software, and a lot of AI. That's where we see the most opportunities, and we really want to focus on the choke point, because AI is, again, it's a really sexy term, but how are you going to make any money off of it? And so the choke point might be step-down transformers. The choke point might be an LLM and the unique access to proprietary data or some level of application software. But I think that the nuance there is pretty deep.
Yeah, and you bring up a good point. When I've been trading since 1989, and when the internet came about and we had that whole run from 95 to 2000, people were like, hey, bricks and mortars don't matter anymore. I'm getting that little CD-ROM from AOL. I'm online, and people would ask me what my internet address is, meaning what's my email alias, and all of a sudden it was about eyeballs. Yeah. There were new valuations. All your CFA work went out the window. You didn't need CMT. You didn't need CFA because it was about eyeballs.
Yeah.
As a person who studies investments, the AI space, I think, is one of the most misunderstood spaces that we've seen.
Yeah.
And people I just see it in the headlines, UPS is laying off 14,000 people. Amazon is laying off another 5-digit amount of people because of the efficiency that AI is bringing to the table. What do you think for the general practitioner is something that they should be evaluating and seeing outside of you go to a help chat on a website, that's probably not a real person.
Yeah.
But where else would people see AI like materially in their lives at this point?
I mean, all the translation services are rapidly migrating to AI. Every kind of interaction with any type of help desk, as you mentioned, is AI. Coding assistance and the ability to, reproduce code efficacy of 82% relative to what a team of human engineers would do, that's rapidly shifting to AI. I think that there'll be use cases in medicine, in all sorts of healthcare, in all sorts of defense and aerospace applications to find out like what's the right heat that you want to, superimpose these two metals together to create an alloy. What does that look like? The more data that you have, the more interesting the applications become. So data is a big opportunity and problem.
So let's talk about a case study now and
Sure.
give you a chance to kind of show off a little bit, and talk about how your strategies, what can they really return, for investors? Give us a typical example.
Yeah, I mean, I'd say that Kraken is a crypto exchange. That's kind of the easiest example to give. Nobody wanted it. It'd been around for a while. There were no sexy investors on the cap table. So you could buy secondary at 3 times revenue. It was CAGRing at 100%. It was EBITDA positive. And they make money in Bitcoin. So if you think that the U.S. has a fiscal issue and that neutral reserve settlement assets like Bitcoin and gold will skyrocket in the coming years, which is the track that I've taken for the last decade, and continue to see unless we do some serious reforms on deficit, et cetera. It was an interesting thing to look at. The catalyst for us investing and being aggressive around it was Treasury Secretary Bessent came on TV and said, yeah, they'll hold $3 to $5 trillion of debt. Stablecoins will. And I said, okay, but they hold $300 billion now. So you're saying they're going to hold 10 to 17 times more treasuries in the next 5 years than they currently do. Well, stablecoin market cap moves 1-for-1 with Bitcoin. So if you actually believe that and you think that, hey, even if the beta doesn't hold at 1-for-1 and it goes to 0.3, you're looking at like a 3 to 5x increase in the price of Bitcoin by 2030. Now, obviously, the price action today doesn't bear that out. But when I thought about it, I was like, why would he want that? He'd want that because the U.S. is government's the 4th largest holder of Bitcoin. I believe U.S. retail is now the 3rd or 2nd largest holder of Bitcoin, so it can recap consumer balance sheets. No different than China, pumping the price of gold and encouraging their citizenry for the last 15 years to invest in it to recap consumer balance sheets due to their property bust. And so it does a lot of different things for the U.S. And then President Trump came out and said, hey, look, maybe we'll write off our debt with a little check for Bitcoin. And that was really telling. That was in, I think, February of this year. That's when it was very clear to me that they were trying to engineer kind of like a bailout of sorts, or when you saw Kissinger go to the Gulf Arab states and say, 5 decades ago now, and say, hey, look, we're going to make you fabulously wealthy. We're going to let the price of oil float. He did that because we needed to bail out the oil patch. It was the biggest sector in the S&P 500 at the time. But how do you offset the consumer drag of higher oil prices? Well, you tell the Gulf Arab states you're going to buy U.S. treasuries with 100% of your surpluses. And that's exactly what they did. And that allowed our government to offset the consumer drag with government spending. And so, thinking through what we need to do, given our deficit and debt, given interest rate fall, is kind of the backbone of how we analyze all these positions and how they fit in our portfolio construction. But that meant that we bought Kraken. And so, 3 months after we bought, they went from the $5 billion valuation where we bought to 15. They're now raising at $20 billion. And that was in plain sight for everybody in secondary markets and in venture capital to buy. Another example is probably Impulse Space. They transport satellites from low Earth orbit all the way to geosynchronous orbit. And no one really thinks of that because most satellites are concentrated in LEO or low Earth orbit. But when we diligenced that company, we found out there was another company trying to buy it 3 times higher than the round price. We spoke to DOW. They're like, look, they're winning every single pilot program we throw at them. They're probably going to win $1 billion worth of contracts with us. So funding them at $350 million as a valuation seemed reasonable, given that they had 50% plus gross margins. We're catering at 400%, and we're going to do close to $100 million of GAAP revenue. When you see a company like that, buying them at that price makes sense, and then less than a year later, they're trading at $2 billion. So I think for us, we're trying to return 3 to 5x net. We bolstered the portfolio with some things that we think are 2 to 3x's that are free cash flow positive, and then we juxtapose that with growthier names that are defining their categories and are the logos of tomorrow. And you could do a lot in venture that way, as long as you're constricting the size of your fund and kind of just not getting caught up in FOMO.
Sounds like a very emotionally mature way of running the money too, not getting caught up. How are we doing on time? We got to wind. We're a little bit over. All right, folks. Well, thanks very much for coming out this morning and being here. Atid Alawalia from Island Green Capital.